Hey everybody, Meredith Harris with Remax of Orange Beach. I talked my good friend Rhett into sitting in with me today and talking a little bit about mortgage lending on condos at the beach because it's different. It's very different.
Yes, it is. Yes, it is.
And a lot of times when I have clients, if they want to finance a second home or investment property, they haven't had a mortgage in a long time because
Sure.
Most of the time people are looking for second homes or investment properties. Are financially stable. They may have owned their house, their primary residence, for a number of years, and they may not have gone through the mortgage process in a really long time.
That's right.
So it's a whole new ballgame out there, and just so we can kind of educate you guys on what's going on, I'm not a mortgage broker, I'm not a loan officer, so I brought in my good friend to kind of walk us through and answer some of the questions that I get asked a lot, just so you are fully prepared when you decide to come to the beach. So Rhett, thank you so much for being with us.
Thank you
Tell
for having
everybody
me.
who you're with, because
Well, I'm Rhett Grant. I'm with
up.
Cornerstone First Mortgage here at the in Orange Beach. My office is here at the Wharf. So great company, really enjoy it. Have a lot of really good products. Really efficient company to work for.
Well, and just before we get totally started, having a lot of products that you can offer, having a lot of different loan products makes the process a lot easier because, as we'll get into in a minute, condos don't always qualify for your normal conventional mortgages.
That's correct.
Not that it's a bad thing to have a different type of mortgage. Condos themselves are just set up a little bit differently, especially down here at the beach.
Right.
So I wanted to start by just kind of going over some of the things that makes condo lending different. I think people who may not be familiar with what Fannie Mae and Freddie Mac are don't understand the different standards we have to underwrite loans to.
That's right. So, well, my number one goal is to get people in a limited review. And limited review, and why, is because you need less documentation to get that condo approved or to get you approved. Because when you talk about condos, you're getting the person approved, but then you're also getting the condo approved, okay? So before Sally in 2020, you could put a minimum down payment down. Typically the reserves were good, the budget was good, so you could, before Sally, get in, okay, for little down. But now, since Sally...
Like the 10% down.
Yeah, 10% down, that's right.
Or just a regular conventional loans.
Absolutely.
Hurricane comes in, changes everything.
Correct, along with short-term rentals, okay?
Yes.
But hurricane comes in, then you start having reserves being depleted because they have to make repairs. You start having budget issues, so all of that stuff starts happening, and now insurance is quadrupled, okay, which is one of the reasons why people have special assessments now. So, it was like a perfect storm, okay? So, when we talk about a down payment of a condo, it's not that 10% minimum down payment anymore, okay? It's at least 20%, okay? But depending on, if you bring in that 20%, okay, like I said, I'm trying to get you in that limited review, okay? Because in limited review, I'm only asking for a master insurance policy and the condo questionnaire, okay? Are the only two things I have to turn in. Unless it's an investment property, then I ask for rent rolls, okay? Because that helps you get approved, whatever the projected rental income may be, that helps the appraisal come up with the projected rental income for that condo.
Okay, well, let me back up just a second.
Okay.
So when people say in a city, lots of condos in a city.
Right.
When people are going and buying a condo for a primary residence, that's one, you underwrite it to the normal standards, just kind of like you would a house, but you ask for insurance, some documentation that the HOA is financially in good shape and some other things. But the difference for the beach condos is, because we have so many short-term rentals, it makes it a non-warrantable condo, correct?
It does.
So
and
there's a difference because non-warrantable condos mean lots of short-term rentals, ownership. That, say an investor comes in and buys 10 units in a building, that would make it non-warrantable. And then what are some of the hotel desk? Rental desk at a condo complex. So like
which could make it a condo tail.
Like your Caribs, your Phoenix All Suites. Trying to think of some others that would, but setups like that make it wave some red flags for regular underwriting. Correct?
Yes and no. Let's start with warrantable condos. Okay, let's start there. Okay, let's make it simple, because a warrantable condo means it does not meet the Fannie and Freddie guidelines. Okay, so it doesn't meet those guidelines.
Non-warrantable.
Yep.
Yeah.
Yeah. Well, yeah. So warrantable means it meets those guidelines. Okay. A non-warrantable condo means it does not meet those guidelines. Okay, which is what you're talking about. So the good thing is we have investors. Okay, that sometimes follow the Fannie and Freddie guidelines, but there's investors out there that don't follow those guidelines. Okay, so which means it might be a non-warrantable condo. Okay, because it's going Fannie and Freddie. But with this investor over here that doesn't follow those guidelines,
they don't care.
It could be a warrantable condo. So what you can't do is get stuck up in that, because being a non-warrantable condo these days are not like it used to be in the old days. Okay, because in the old days it used to be a deal breaker, but now there's so many investors out there that take non-warrantable condos, and sometimes they're warrantable because they don't follow the Fannie and Freddie guidelines, that it's really not that big a deal.
Matter.
It doesn't affect your resale. It doesn't affect anything like that. It's just non-warrantable.
Yeah, I think, when I first started, and several years ago when we first got into this, everything was warrantable. Nobody asked too many questions, and you just made loans on everything.
That's right.
And then once the hurricane came through, Fannie Mae and Freddie Mac kind of, it's my understanding, correct me if I'm wrong, they decided they wanted to tighten up their underwriting, so it made it a little bit more difficult to get a regular conventional loan.
Correct.
On a
And
lot of
which
these
short-term
condos.
rentals is a big thing of that. Yep. That's one of the things that definitely Fannie is not into, and that's the short-term rental game on condos.
Yes. So pretend like I'm getting a loan from you. Okay.
Okay.
So we start this process. I say, Rhett, I want to get a loan on a Phoenix 5 condo. I've fallen in love. I've got to have this. It's going to be my second home. And how do we go about this?
All right. So number one, I'm going to ask you to fill out an application, okay? Because that's the only way for me to paint a picture, to get a picture and paint a picture of your world, okay? So we're going to ask for 20% down. I'm going to ask for the condo questionnaire, okay?
Okay, the condo questionnaire, let's just to get way in the weeds on this, it's a series of questions that the condo HOA answers, and it will cover all of the questions that Fannie Mae or Freddie Mac would ask about warrantability. Now, if I'm putting 25% down, that questionnaire is a whole lot shorter, correct?
It is. That's why I try to go limited review, okay? Because on the limited review, like I said, the master insurance policy, the condo questionnaire, and sometimes the rent rolls, that's the only thing I have to turn in, okay? So we might go that and we're good, but then if we have to start going full review from some of the stuff on the condo questionnaire, okay, yep, some of the stuff, then we have to start bringing in budgets and balance sheets and things of that nature, which sometimes opens up can of worms and makes you dig deeper into the condo. Okay.
And what I found, Rhett, just in my experience with this, is sometimes the HOAs don't understand how to answer the questionnaires, and then that will raise some red flags if they answer something.
Yes.
They just don't understand how they're answering it. And also, some things that just don't matter, lenders kind of nitpick. No offense. So the rule of thumb now for my clients is, I say, if you're going to buy a condo, you need that 25% down. Period.
Sure.
No ifs, ands, or buts. Or you're going to need to do some kind of different type of loan, like a DSCR or another of your products that doesn't require.
Right. So if you were coming in, we would start with 20% down. We're very aggressive for the way we go. Okay. So I'm going to try to do 20. If you have in your mind you're going to do 25% down, and that's what I ask really is one of my upfront questions is how much are you willing to go on LTV? Are you 20, 25, 30%? The more you put down, the more you're willing to go. Number one, the easier the condo is to get approved and to get you in that condo. Number two,
the easier it is for you to cash flow.
Yeah, that was my second thing. The easier it is to cash flow because now your LTV is your payment's not as high. So those are the two things I'm going to ask. So if we can go at 20%, I might have to come back and tell you we have to do 25%. Depending on the program, say DSCR, we're going 25%, but the investor, the only way we can get this condo approved is to go with this investor, and they add a 5% short-term rental, which now you have to put 30% down, okay? So that's why I kind of go through the different guidelines. We read guidelines all the time. So if you're coming in, that's what I need to know, how much you're willing to put down. And then I have to know the condo. I get the condo questionnaire. I get the insurance policy. And then once again, rent rolls and budgets. Most of the time I go ahead and get the budgets because I want to start looking at them. I kind of go worst case scenario, so I can start looking at the budgets to see if the reserves are there, look at the balance sheet, see where the money's being spent, see what's all on their balance sheets and stuff. So that's what I would do. Then I would come back to you and say, hey, we're good on the condo. I would submit the condo questionnaire. Because I would get you approved first, of course. Okay, you're good. Credit's great. You show me you have enough money for the down payment. You have the reserves. So now the condo is good. We have got the condo questionnaire, which is filled out correctly. We like to see. Insurance was good, and we didn't have to bring the budget in yet. Okay.
So I think one of the things that sometimes my clients get confused about is it's not just you qualifying for the loan. You might have the greatest credit and all the money in the world. It is not you that sometimes is the problem. Sometimes the condo building itself is the problem because the condo building also has to qualify. So it's almost like two qualifications, condo building and the person itself.
Yep. And sometimes it's a blessing. So you come and you really want that condo, and I come back and say, hey, it's not really approved. Their budget's under. Their special assessment is $120,000 coming down the pipeline that you really don't know about yet. So it's really not a good idea for you to buy this. And a lot of people don't want to hear that, especially realtors. When
Yes.
you're trying to sell it, and I'm trying.
A deal killer.
That's right. But at the same token, I got to be able to sleep at night. And if a condo is not approved and it's a bad situation for my client, I can't put them in a bad situation. Then them look back at me and you and be like, why would you put me in this situation?
Well, and that's one of the reasons I do trust Rhett and his judgment, because he's a good human, and he will not, he'll be very, very honest and open. He's not trying to sell a deal. He's trying to help you get where you need to get in the best way possible.
Absolutely.
Yeah.
I got to be able to sleep at night.
Yeah. So, all right, so once I qualify and the condo qualifies, then we can move forward to closing, and everything should be
Absolutely.
just fine.
That's right. Once we get, it typically goes like this. Once we submit everything to underwriting, okay, they come back with a conditional approval, okay? So we get the conditional approval and say, hey, this is what we need. The H06 policy, which is your inside the condo policy, insurance policy, and then a couple more things they may need. We resubmit that, and then we get the clear to close.
Okay. So all that's clear as mud. I want to throw some curveballs at you.
All right, let's see what you got.
What if I'm a self-employed borrower? Because I know that's difficult. What kind of products do you have for the self-employed borrowers?
I deal with a lot of self-employed people, and we have a lot of really good products. The number one thing that sticks out are bank statement loans. Okay, bank statement loans are really, really good. If you, number one, and this sounds crazy, but some people don't file their tax returns. Okay, so if Meredith came to me and said, "Hey, I have not filed my tax returns,"
some of those clients.
That's right, in the last 3 years, but they make really, really good money, which say they make. For easy math, they make $10,000 a month. Well, we cut that in half. We look at the last 12 months of bank statements. We say it averages out to $10,000 a month. We cut that in half, and they qualify for $5,000 a month. That's their qualifying income. Even though they've not filed their tax returns in the past 3 years, we're going to be using those bank statements just for that. That's probably one of the best self-employed. Then, of course, we have 1099s. We have P&Ls, which you get from your CPA. So those are really, really good non-QM products.
Okay. DSCR is a buzzword, and
that
I know that some people love them, some people don't, but and generally the rate's just a tiny bit higher. But could you just, like, in a nutshell, tell people what a DSCR is?
It is, absolutely. You at least have to bring on the
debt service coverage ratio.
That's right.
Correct?
That's correct. And typically you have to bring 25% to the table. And one of the reasons why, if you're a first-time investor, we look for a 1-to-1 ratio. What a 1-to-1 ratio means if the mortgage, the HOA, the taxes, insurance all come out to $1,000, the appraisal or the rent roll has got to come out to be $1,000. So that's your 1-to-1 ratio. If you're a first-time investor, it has to be a 1-to-1 ratio. If you have numerous investment properties,
which is where I see this coming into play the most, usually, is people have multiple investment properties, and this is just an easier way. If their debt to income, good grief, there's a dog in the background.
Sorry about that.
If their debt to income, it would be too high for them to personally get the loan. Sometimes this DSCR is
absolutely.
an avenue.
Yep, that is definitely an avenue, because we don't even look at your income. We don't even look at DTI. We don't look at any of that. We are just qualifying you on the 1-to-1 ratio. But if you have multiple properties, sometimes it can be 0.80, 0.75.
On how your other properties
absolutely.
Are doing.
So it's just, if you have 5 or 6 other properties and you want to do a DSCR loan, we figure you know what you're doing, or you wouldn't be buying this 6th property. Yeah. So, but it is a very good loan. But like I said, back to condos, if you do a DSCR, sometimes they do add that 0.5 for short-term rentals, which brings it up to 25%, to 30%. Yep. And really, if you start going under that, it really doesn't cash flow unless you have numerous properties, such
Yeah.
as,
Yeah.
that you can go under the one-to-one ratio.
It drives me crazy because I'll have clients call and be like, I don't want to put down as little as possible and I want to make money on it. And I said,
Yeah,
those two don't
absolutely.
go together. They just don't,
No.
you know.
No,
Condo
they don't.
ownership costs are higher than they used to be with insurance and HOA
That's right.
dues and, and rents aren't crazy. They're just average over the past few years. So,
It's a long-term investment.
It's a long-term investment, and it takes a lot to get a property to cash flow with a mortgage. So you're going to want to put down as much as possible. It makes the loan process easier. It makes your cash flow a lot easier.
That it does.
So any parting words of wisdom?
No, it's just, I guess what I want to tell you, if you were interested in buying a condo, please talk to someone. We save a lot of deals down here because you have people, say in wherever you live, say Tuscaloosa, Alabama, and you want to come down here and buy a condo. All right, well, I'm going to use my own lender up here. Okay, that's fine. But then I can do it, Meredith, I can do it.
No.
And then Meredith calls me and says, hey, we close in 2 weeks and they just got denied. What can you do? I'm like, send me their information, okay?
Yeah.
So I would say this, if you're gonna buy a condo down here, if you're gonna buy an investment property, I would make sure you talk to people that deal with investment properties, that deal with condos, that know the lingo, know what they're looking for, know the guidelines, because there's so many different investors with so many different guidelines that you have got to be up to par to know those guidelines and where things go. So I would just say, number one, make sure you find a realtor that knows what they're doing down here, and number two, a loan officer that understands the game down here.
One, and not to toot Rhett's horn too much, but you need somebody that knows what they're doing and has lots of products that they can offer you. Because if you start out conventional and maybe the condo doesn't qualify, Rhett can switch you over to some non-QM product that will allow you to follow through and get the condo financed. Whereas other lenders in other areas of the country, they may not have the right products to help you, and then you'd be starting from scratch if you had to switch to a local lender. So before you jump into the market, call me, call Rhett, and we'll get you set up. And we look forward to working with you. And thanks for joining us today.
Yeah, thank you.